So what we're seeing in today's marketplace is it's difficult for new home buyers to obtain insurance. That homeowner is going to go from paying $2,000 a year to approximately 4 to 5 grand a year for the next 5 years. They're paying more money in premiums than the cost of the damage. What's going to happen is their current insurance company, who insured them for years, who paid this $20,000 claim, is going to non-renew the insured. They're going to non-renew them, and they're going to say, this is not profitable for us in the long term. We're going to non-renew you.
Hi, Sam.
Hey, Charlie, how's it going? Good to see you.
Going pretty good. Thanks for joining us on the show. And we're going to talk about some really, really exciting topics. A lot of topics that my clients are very, very interested to know. I mean, a lot has happened in 2025. I mean, we started the year with some really big fires down in Southern Cal, and then with some major changes in the insurance industry. Can you tell us a little bit about yourself and how you became an insurance guru, right now?
Yes, I'm happy to. So first, Charlie, thank you for having me on your show. I'm happy to be here. And a little bit about myself. I've been in the insurance industry since 2016, running our own firm since January 2019. And we're very familiar. We consider ourselves an expert in the space. We have a very large agency, and we specialize in helping homeowners and property owners obtain insurance in a hard insurance market. A lot of carriers have left. A lot of carriers have left for good reason. There was a $500 billion fire 6 months ago. The Department of Insurance is very difficult to deal with in terms of get rate increases, which we'll go over, which we'll go over in a little bit. And then we also want to make sure that our clients are getting the correct insurance at a good deal because everybody wants a good deal. Right. So what we're seeing in today's marketplace is it's difficult for new home buyers to obtain insurance because one, there's a little bit of a sticker shock. They were always told insurance is 1,000, 1,500 bucks a year because their parents had insurance for years or their friends had insurance for years, and the pricing that they're seeing off the bat is higher than what it was. So that's kind of off the bat. Two is that the home buying process is a little bit different today from insurance. Most realtors and banks know how difficult it is to obtain insurance. It used to be insurance was done at the very end of the escrow process. Now insurance is done more in the beginning. I would say honestly within the first 5 days, someone is telling the buyer, hey, make sure to start shopping insurance now because everyone is aware how difficult it is, and heads up, it's going to be a little bit difficult to obtain. So get multiple quotes, shop rates with multiple carriers. If you don't have access to multiple carriers, get access to a broker, someone like us who can shop rates, go over the quotes with you in detail, line by line, so you understand what you're paying for. And then lastly, a big thing that is kind of becoming more of an issue today that was never an issue prior is sellers' claims are now affecting buyers' insurance, which means if in today's market, if a seller had a claim, regardless if it's a $500 claim or if it's a $300,000 claim and anything in between, plus minus, those claims are now affecting the home. What carriers are seeing is that if the seller has a prior claim, the statistical likelihood of the new buyer having a claim of similar size in comparison is way more likely than if the seller did not have a claim at all. So a
Wow.
lot of carriers will just decline the risk altogether if the seller had a claim, and if not, they will take it but at a higher premium. So that's becoming an issue now. And then another issue that's becoming an issue that's more relevant today is something called a fire score. What a fire score is how likely this home will suffer damage, any damage, smoke damage, fire damage, wind damage, any damage is going to come directly from a firestorm. And what most people think is, oh, my house is not in a fire zone because I'm not in a fire zone. But what we're seeing now is anything within like a 2 mile radius of a fire zone is now considered a high fire score. So it goes on a scale from 1 to 10. Anything 2 and above is a flat decline for a ton of carriers. Some carriers will send it to underwriting approval if it's a 2, but most carriers will decline it altogether. So we're doing a lot of combinations of California Fair Plan and difference in conditions. The carriers are expecting it to be a difficult marketplace for the next 3 to 5 years. And the reason why it's going to be difficult is carriers like to ease up restrictions in underwriting when they make a profit. The issue is that none of these carriers are making a profit right now. The people are filing more and more claims than ever before. The size of the claims are increasing, and the frequency of claims are increasing. So in order for
Right.
it to get better, insurance companies have to make a profit, which means people have to stop filing claims. But every once a year now, there's like a massive fire. There was a $500 billion fire. That one occurrence is going to take years for carriers to recoup their losses on. So they're going to have to
Wow.
basically start jacking up rates to get to a place where they feel comfortable to taking on more business. And then the clients are upset because they're getting these 30+% rate increases. Um, and the unfortunate part is that it's across the whole state. Let's talk about the insurance crisis specifically in California. So premiums are up on average 30% year over year. The reason why is there were no rate increases when COVID hit. When COVID hit, inflation started skyrocketing, and the cost to fix damage, the cost to fix home claims, both on auto and home, but let's focus on home now. The cost to fix home damage that resulting from fire claims, water claims, vandalism claims is increasing. The state did not allow the state did not allow insurance companies to raise their rates. So the insurance premiums and the rates work in California is the Department of Insurance determines the rate. Let's say you own a pizza shop and the amount of money that you can charge for a pizza is determined by the Department of Pizza. So let's say the Department of Pizza allows you to sell your pizzas for $10 a pie, and it costs you $8 to make it. It costs you 8 and you sell it for 10. You make the $2 profit after covering all your expenses and you have a great business. Let's say you decide to sell 3,000 pizzas a day, making 2,000 bucks a pie. Great business, you do this for years. Then COVID hits and your costs double. It's now costing you $16 to make a pizza, but the Department of Pizza is still only allowing you to sell it for 10. A year goes by, they say, "Look, you've made a profit for so many years. The people in California are suffering. We're not letting you raise your rates. Suck it up." And the carriers are saying, "You know what? We're writing so much business here. We really can't afford to leave." They stick it up. Another year goes by. The rates continue to double. Another year goes by. You have record high inflation. Your costs are now even higher than they were before. Eventually, it's costing you $30 to make a pizza that you're forced to sell for 10. So what are you going to do as the pizza shop owner? You're going to stop selling pizzas because you're a business, not a charity. So they will shut their doors, close their doors, limit the loss, and go to other markets that are more profitable. After 80% of the pizza shops close down and leave California, the Department of Pizzas realizes, if we don't let the existing pizza shops raise their pricing and make a profit, no one in California is going to be able to buy pizza anymore. So what the Department of Insurance realized is they have to start giving rate increases quick and efficiently to carriers. So carriers started getting, uh, on average, 30% rate increases for existing businesses that were not non-renewed, and new policies are up like 200%. And there's a gap
Wow.
right now. So if people are price shopping because their renewal that they've been with for years went up 30%, there's really nowhere to go. I would advise them to stay put. Uh, and I would advise them to stay put. They're still welcome to call and shop around to get quotes, but chances are their prices are going to be unbeatable. Most of the pricing that we're writing and we're seeing competitive is for new business. So someone buying a home for the first time, someone getting insurance because they were non-renewed on their existing home. Those are the two policies. I would say 95% of the policies that we are writing today are for new purchases and non-renewals. Um, and there is sticker shock, but again, the reason why is just kind of to go back to my pizza shop example. It costs more money today for an insurance company to assume a risk than it did 5 years ago. And historically, pre-COVID, rates went up 2 or 3%, up and down, depending on how inflation worked, depending on how much profit the carrier made, and it was pretty standard. COVID totally switched the game in California, but the main reason is that carriers are playing catch up. Carriers need to make a profit, and the state's aware of it. And then on top of that, you factor in a $500 billion fire, which the rate we have not seen the rate increases yet from the fire. Everything we're seeing today was determined 12 to 18 months ago. So um,
Wow.
it's gonna
Wow.
get it's
On your
gonna get
next,
yeah.
it's gonna get ugly.
It's not ugly. I mean, it's bad, but it's going to get worse. But the good news is that once it gets worse, I don't think it's going to happen again. I don't think we're going to have another $500 billion fire again. I think the state learned you have to keep water in your fire hydrants. You can't have reservoirs empty. You can't have brush going up 6 inches to someone's backyard. And I also think on the flip side, a lot of homeowners now are putting water sprinklers on their roof if they're living in high fire zones or high fire zone adjacent zones. So,
Wow.
and also we can't be relying on the state anymore. Unfortunately, um, the carriers are leaving just due to it's very difficult it's very difficult to operate a business correctly in California, and I think the state is making it a little bit easier. They're discussing rate increases now of 17% for 2026. I think that's
Wow.
probably going to end up being higher, but um, that's that's as far as the rates.
Cool.
And the reason why a lot of homes are uninsurable is also a lot of homes in LA and in California specifically are older homes, especially in the Bay Area and Palo Alto, Northern California. A lot of these homes are 100 plus years
Yes.
old. And insurance companies do not want to insure a 100-plus-year-old home because the chances of that house having a claim, let's say because the roof hasn't been updated in 30 years or 50 years or how, versus a home that's brand new. Homes that are built brand new have fire retardant technologies, have wind mitigation structures. They're mandatory to have fire sprinklers built into the home and interior fire sprinklers that the older homes don't have. So it's a significantly higher risk. So what we're using now is a lot of surplus and excess lines carriers to insure these homes. What that means is it doesn't mean it's a bad insurance company and a non-surplus is a good insurance company. All that means is their risk tolerance. So admitted
Yeah.
carriers are carriers that are based in California. They prefer a preferred risk. Newer homes, homes with updates, and they preferably want to see updates in 20 years. They want to see a new roof, updated electrical, updated plumbing, and an updated HVAC all within 20 years or newer. And that will give you a
Yes.
favorable company, favorable rates. If the home is older than 20 years or has lack of updates, you're going to the non-admitted side, which are carriers that are not based in California but are licensed and that are licensed to sell insurance in California. They will take a higher
Cool.
risk for a higher premium, and we're seeing a lot of those as well. Why it's happening? So the main reason, I mean, there's a few main reasons, but insurance
Right.
in California prices are increasing. A big factor. So the cost, insurance companies will assume a certain amount of risk. Take, for example, State Farm, because State Farm was the first massive carrier to leave California, and and this was their main reason, is State Farm, let's say, will insure $100 billion worth of homes in California. They don't have $100 billion in the bank, where God forbid if all these homes burnt down at once, they don't have the ability to write a $100 billion check. So what they do is they purchase something called reinsurance, which says we have reserves, let's say anywhere from $100 million to $2 billion in cash on hand at any given time. For any claim above $2 million, we purchase reinsurance, and there's different levels of reinsurance, and they will come and pay the difference if the claim and the catastrophe exceeds what we have in reserves. And the cost of reinsurance was getting so expensive, combined with the Department of Insurance not allowing State Farm to raise the rates, combine that with increasing cost of claims and frequency of claims, State Farm left. And after State Farm left, Geico left shortly after, and then a ton of other insurance companies left. Catastrophic losses. You have fires. In the last year, we've had flooding, hurricanes, and fires. It's pretty wild. Impact on home buyers. So, how does this affect home buyers? A lot of home buyers, their debt to income ratio is very tight when obtaining a loan to purchase a home. And a lot of times this does not get taken into account in the numbers. So they'll put together an estimate to get their pre-approval. They'll open escrow and realize, oh man, our insurance costs are double to triple what we thought they were going to be. We are no longer going to be able to qualify. So what we're doing is that's usually when we get involved. They got a quote that's very expensive. They'll call us as an agent so we can go ahead and shop rates to one, save the deal so they can still purchase the home of their dreams. The agent can get the deal, and the client at the end of the day is happy because they just got a better deal on insurance. And then another option is to tailoring the insurance policy to making sure it best fits the client's needs. They might be a first-time home buyer. They might only have $50,000 or $100,000 worth of things, and they might not need the full $300,000 or $500,000 of personal property coverage that a home insurance policy might give you. So we can trim that down to save cost, as well as entertaining higher deductibles and really tailoring the policy to make sure it best fits the client's needs, where they can get the best bang for the buck. So the largest factor that is affecting insurance today in California is the fire score. It's a fire land score, it's a brush score. And here's why it matters, and here's how to check it. So if you go on Google and you Google an address and you're surrounded by greenery, you're in a high fire zone and it's going to be tough. If you're within a 2-mile radius of that high fire zone, it is still going to be tough. Some insurance companies are more lenient than others. And the best way to check is to call an independent agent who can shop rates and tell you the fire score. It ranges from 1 to 10. 1 is minimal likely, and almost any carrier will take it. 2 and above, um, carriers start declining it. Anything above a 3 is a hard decline. And workarounds for that is we're combining a combination of California Fair Plan, which is essentially a fire-only policy combined with a difference in conditions. California Fair Plan covers fire, smoke, lightning, vandalism, malicious mischief, riot, civil commotion, internal explosion, aviation, car crashes, and windstorm. Does not cover water, does not cover liability, does not cover collapse. And we're supplementing the California Fair Plan policy with a difference in conditions policy. And a difference in conditions policy covers all of the gaps, all of the perils, causes of loss that California Fair Plan does not offer. And when you combine the two together, you have quote unquote normal home insurance that would cover what a normal home insurance would be if it was not in the high fire zone. Um, and one thing to note is that there's a lot of stigma that California Fair Plan won't have enough money to pay my claim or they ran out of money. And the truth is they did run out of money in the Palisades fire, but there are systems in place to where if that happens, their insureds, the California Fair Plan insureds, will get paid out, and those systems worked. The way California Fair Plan works is if there is a large claim where they exhaust their reserves. So in January, the $500 billion fire, they had $200 million in the bank. So who's paying the other $499.8 billion is other insurance companies, if they want to sell an insurance. Let's say I'm State Farm. I decide, hey, we want to start selling insurance in California. The Department of Insurance will say, okay, great, you can totally go sell insurance, but if there's a catastrophe, you will be given an assessment to pay a certain amount of the claim. And those systems kicked in, and every carrier paid anywhere from $1 billion to $10 billion, depending on how
Wow.
big they are, how profitable they are, and a lot of other factors. And those systems worked. Hartford paid, I think, $9 billion. Travelers paid $2 billion. A lot of insurance companies came in and paid, and people got paid out. Granted, a lot of people were underinsured, um, but people got paid out. People got paid out quickly. People got paid out within days, and and the systems worked. So people should not be afraid. California Fair Plan worked. People got paid out, and they will properly insure your home. Flood risking. All right, so here's how flood insurance works. Flood insurance is never, ever, 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 ever covered under your standard home insurance policy. If a if the water originates inside your house, for example, and it's a sudden cause of loss. So if a pipe bursts, if your toilet leaks, if you have a if your kids are filling up the bathtub and they run away and that starts the flood, that is a sudden instant cause of loss. That is covered under your home insurance. Flooding, by definition, from an insurance company standpoint, is groundwater seeping in, meaning it's raining and raining and raining, and the groundwater starts to rise and flood, and that groundwater starts to seep into your house. That is called a flood. That is not covered under home insurance, and flooding is only covered if you have a separate flood insurance. We're seeing a lot more lenders require flood insurance as a requirement. Now, most flood insurance policies are not so expensive. Depending on how much coverage you get, they range from $500 a year to $3,000 a year, depending on how high the flood score is and how much coverage the insured wants to have for their belongings and for the structure. Um, and and the other peril that is not covered as well on home insurance is earthquake insurance. Earthquake insurance is never covered under your standard home insurance in California. You'd have to purchase a separate earthquake quote, and we are legally obligated to send out an earthquake insurance quote offer when obtaining home insurance in California. So, cost, drivers, and hidden factors. So this kind of touches on other things that we've discussed. Um, Catastrophes, large weather catastrophes are happening more frequently than ever before, whether it's a wildfire, whether it's a hurricane. I know in Texas, they just had this whole flooding issue going on where unfortunately hundreds of kids died. And these are
Wow.
coming
Yes.
more and more frequent.
All
So
right.
we're having these large weather events happening more frequent, and the cost to fix these damages are skyrocketing, and we can't predict them. We can just raise the cost of premiums so that when these events do happen, we have enough money to replace and repair the homes correctly. Uh, and so that does create a large ripple effect all the way down from people buying a home, people whether or not they want to live in a certain area. We're seeing homes in high fire zones the sellers are giving credits to the buyers to purchase insurance because the insurance is now so much more expensive and it wouldn't make sense. A lot of we've insured homes like in the hills, premiums that used to be 2, 3 grand a year are now 50 to 100 grand a year because their 12,000 square foot home is literally on a place that burnt down 8 years prior. So
Wow.
and insurance companies are aware of that. So again, the fire score is a big issue in these disasters. They're only becoming more frequent, so carriers are just having to prepare. And they're also giving significant discounts to homeowners that take steps to minimize damages and to take steps to prevent from wildfire exposure. So those steps could be we will no longer allow trees overhanging the roof. The roofs have to be cut back within 6 feet, so there's a defensible space between the property and the brush. They want to make sure that the windows are dual pane. They want to make sure that the eaves are enclosed. They want to make sure that that there's no dry rot present on the property. They want to make sure that that if there's dry brush around the home, nothing is within 6 feet, that there's a defensible space so that if these things do torch, it doesn't burn down the home right away. The homeowner has a fighting chance to put out the fire, to get out, and to minimize damages as well. And then lastly, the biggest effect that's happening on home insurance, really more car insurance, is is uh, is personal injury claims. I'm sure you've seen this. Every other billboard now is a personal injury attorney. Every other ad on TikTok, on Facebook, on Instagram is a personal injury attorney. Uh, uh, in California, it's not as bad, but take Nevada, for example, 80% of car accident claims have a bodily injury aspect with a 100% payout of policy limits. So what that means is regardless of how bad the accident is, the carrier knows they're paying out 25 grand, 100 grand, $1 million, whatever the limit is. And that is also now coming into the home. A homeowner is having a party, and one of his friends drinks too much and slips and falls. And he may
No,
or may
that
not
never
be injured,
happens.
but he's gonna sue the homeowner for and that's one example. Another example that we're seeing is with kids. One kid will have another kid over for a play date. Kid slips and falls because kids get hurt all the time. And now that parent is suing the other parent saying that you were negligent in babysitting my kid. Now the parents could care less. They're going to give it to the insurance company, but the insurance companies are seeing more and more of these. Um, we had a claim where one kid fell, chipped her tooth, sent the
Ah,
bill to the insurance company, and this is a baby tooth, right? But again, the insurance company didn't just pay the cost; it's pain and suffering, lost wages. So you have a a couple $1,000 repair now been like a $50,000 payout for the insurance company because everyone sees dollar signs when it comes to these things. So the cost. This is another aspect. You can call it uh, social inflation, but the premiums are skyrocketing for again, it comes down to cost of claims, frequency of claims, and the increasing rise of people filing claims. It used to be we speak to people that have owned homes for 30 years calling me saying, "Hey, State Farm or Farmers or Nationwide, they non-renewed us, but I've been with them for 30 years and I never filed a claim." They're not renewing it because of them. It's because all of their neighbors are filing claims left and right. And unfortunately, the good Samaritans, the good people, are paying the price um, because insurance doesn't single out the good people versus the bad people. They charge a blanket limit on everybody. Okay, so let's say you have a client. They have home insurance. Their premiums are $2,000 a year. Okay, they had a pipe burst and caused $20,000 of damage. So they're going to file a claim. They're going to pay their deductible, 1,000, 2,000 bucks. The insurance company will pay the difference. So what's going to happen is their current insurance company who insured them for years, who paid this $20,000 claim, is going to non-renew the insured. They're going to non-renew them, and they're going to say this is not profitable for us in the long term. We're going to non-renew you. Now that homeowner is going to go from paying $2,000 a year to approximately 4 to 5 grand a year for the next 5 years. They're paying more money in premiums than the cost of the damage. They would have been better off self-insuring. Here's why this becomes an issue. Most people don't have 20 grand to shell out to fix a claim. They don't have the know-how to fix a claim. They don't know how to hire mold mediation companies. They don't know how to hire GCs. They may or may not have a handyman, but when water's coming down from the ceiling, they get nervous and they're calling the insurance company, not realizing that they're shooting themselves in the foot. So what we're advising clients now is after paying the cost of your deductible, if the insurance carrier will pay 20 grand or less and you have the means to do it, we legally can't tell you to not file a claim. If you want to file a claim, we're more than happy to help you file a claim. Just be aware that you'll be paying double to triple whatever your premium is now for the next 3 to 5 years. So taking that into consideration, if you have the means to pay this out of pocket, you'll save more money in the long run. If you don't have the means or you prefer to go through insurance, 100% we're here to help. We're here to hold your hand through the entire claims process. We help file the claims on the client's behalf. We help them get in touch with adjusters. If there's any disputes, we go at bat for the customer to make sure their claim is getting paid out quickly and efficiently. Um, and one of the benefits as well is going through a broker is because it's more of a personalized service. If it's instead of calling a 1-800 number and speaking to a stranger every single time, you have one person who handles your billing, your customer service, your claims, and you have one point of contact to handle everything in-house. So try not to file claims unless you really, really need to, or if it's a catastrophe. But
Okay.
that's kind of the idea. Okay, so this kind of comes down to your wheelhouse of dealing of how home buyers, new home buyer, whether it's a first-time home buyer or someone who they're buying their 10th home, how they can be strategic in obtaining insurance correctly and efficiently where all parties are happy. The deal can close, the agent can get the deal, and ultimately the home buyer can purchase the home of their dreams. And here's how it works. While you're in escrow, in the beginning stages of escrow, get multiple quotes, shop rates. Call the farmers and the state farms, but also call independent brokers who can shop multiple rates. Chances are the broker is going to come in competitive and offer better service while doing that as well. And then another option is that we're not tied down to one company. We don't work for the insurance carrier. We are the client fiduciary, and we hold that to the highest standard. We will do whatever it takes to make sure the client is happy, that they have the correct coverages, and they understand what coverages they're getting, and to make sure that it all goes smoothly. And then we also work uh, in in cahoots. We work as a tight net between the mortgage officer, the mortgage broker, the real estate agent, and the client. We're also seeing in all the emails to make sure that we are getting the correct mortgagee clauses, that the insurance is getting paid by the lender at closing, and that it all goes smooth. Um, and then also just to budget realistically, it says 2 to 4x higher than Zillow. Make sure that you get proper quotes. Don't just rely on Zillow because 9 times out of 10 it is inaccurate. And we see it go both ways, 2 to 4 times higher, 2 to 4 times lower. You want to make sure that you're getting accurate quotes. Quotes are in hand. They've ran all the reports. The last thing you want is to get a quote in hand. They never ran the reports. They're finally getting to bind the policy at closing, and they're like, oh shoot, the seller had 3 claims. We're not willing to write this policy. So now escrow gets pushed off. They lose their deposit. It costs a bunch of money. Everyone gets frustrated, and everyone ends up yelling at the insurance agent. So just make sure that the the quotes are ran, and it is a finalized quote that is bindable, so that there are no surprises uh,
Wow.
towards the end. And last but not least, this is very important. There's different types of home insurance, and they're not so clear. Okay, and lenders pick up on this right away, but if a lender tells you and it's 3 days before closing it's an issue, now you have a problem. So you want to make sure that when you're getting home insurance, it's replacement cost and it is correctly insuring the home for a proper dwelling amount based off of a replacement cost estimator to make sure that if the home is burnt down today, there's enough money to replace the home as is. And the difference between replacement cost and actual cash value is as follows. Actual cash value takes out depreciation. So let's say you have a home with a roof, and let's say this roof has a 50-year lifespan and it costs $50,000 to replace the roof. 20 years in, the home burns down. Okay? If the home is insured for replacement cost, the insurance company does not care how old the roof is, whether it's 20 years old, 30 years old, 6 months old. They're going to write you a check for 50 grand for the new roof. On actual cash value, they take out the depreciation. So let's say you have a 50-year roof and 20 years in, the house burns down. They're taking out 20 years of depreciation. So 50,000 bucks depreciates $1,000 a year. They're giving you a check for 30 grand. Now, if the whole house burns down and you're getting pennies on the dollar across the board for replacing your home, you're not replacing your home. You're replacing at best 40 to 60% of the home, depending on how old it is. Now, actual cash value is avoidable at all costs. A lot of times it's unavoidable either due to the age or the claims history or lack of updates. And when that happens, you have to make sure that the loan amount is greater than or equal to, the ACV amount, the actual cash value amount, is greater than or equal to the loan amount. If you're going with replacement cost, the replacement cost number can be lower than the loan amount. Because a lot of times when you're buying a home in California, specifically Northern California in Palo Alto, you might have a home that might cost 800 grand to build, but they're selling for $6 million because the land value is really what you're paying for. If the same home was in Ohio, it would be a $300,000 house, right? So
All right.
insurance companies, they don't care what you paid for it. They don't care about acquisition costs. Someone could have gifted you the house for free. You could have overpaid. You could have underpaid. All the insurance company cares about is if the home is going to get destroyed today, how much is it going to cost us to replace it? And so you want to make sure that when you're insuring a home, replacement cost is key. Now, secondly, a lot of carriers are putting sublimits on water or excluding water altogether. Some clients are okay with that because the savings are significant, but what you don't want to happen is to think you have water, your policy excludes water, a pipe bursts, and now you're out of pocket 100 grand to fix this. Very few people have 100 grand ready to go on a dime's notice to fix a water leak. It's not realistic. With that being said, if a client is tight on funds, there are instances where it can make sense where you don't exclude it altogether, but you can put on a water limit of 50 grand or 100 grand instead of having it onto the full limit. And then lastly is wildfire defense and loss of use. Loss of use, if your house burns down, you want to make sure you have enough loss of use for you to live in a comparable place for a minimum of 18 months. So if houses in your area are renting for 10 grand a month, you want to make sure you have minimum 180 grand loss of use. And then lastly, wildfire defense, you want to make sure you have at least 6 feet of defensible space between your home and whether it's trees or brush or bushes, an old wooden fence that's dry rotting. You want at least 6 feet so that if those things do light, they don't take the home with it.
Hey, Sam, thank you so much for telling us. So we're basically listening to you about the state of insurance in California. What kind of advice can you give the homeowner in California about, you know, just basically home insurance in general? Your top 3 tips.
Top 3 tips. That's a great question. 1, get multiple quotes. Don't just settle on the first quote you get. 2, understand your coverages because that's a big one. And 3, make sure that the deductible on the policy is within reach. Don't stretch for a $10,000 or $15,000 deductible to save $300 a year. You want to make sure that if a claim happens, money's going to be tight and you can stomach whatever deductible you're going to choose.
Okay, those are really good advice. Thank you so much. Thank you, Sam, for talking to us about the state of insurance in California. Again, if you like this episode, please don't forget to push the subscribe button and the like. And Sam's information and contact details will be in the description or in the comments below. Thank you again for joining us, and don't forget to watch the next one. We're going to have a couple more very interesting guests. Thank you.